The automobile industry is encountering an unparalleled market plummet, and the depreciation observed so far in 2023 is trivial compared to the impending downfall, argue experts from UBS and Cox Automotive. The surplus of cars on the market has sparked a price battle that may lead to a crash far worse than the one during the financial crisis. Many auto dealers are in the throes of a disastrous situation, but it also implies that U.S. drivers might finally experience some reprieve after years of substantial increases that rendered cars progressively less affordable and escalated average payments to unprecedented highs. That's the focus of our discussion today. But before we proceed, we would appreciate your support for our work with a thumbs up, and remember to subscribe. Following the new and used car prices reaching record-breaking heights as recent as the previous summer, specialists are cautioning about a significant shift in the U.S. automobile market. As the supply significantly outstrips the demand, prices are forecasted to plummet drastically in the second half of 2023. Over the past few years, various factors have resulted in affordability issues for U.S. motorists. Used car prices escalated by more than 40%. While new cars surpassed the $50,000 benchmark for the first time. The pandemic hindered assembly lines and intensified a global computer chip shortage, thereby constricting supplies and contributing to an upward trajectory in vehicle expenses for over 25 months. This situation drove auto manufacturers to realize they could maintain lean inventories for more profitability. But that was prior to the onset of a consumer recession. 2023 is anticipated to be the year when prices finally take a dip, analysts suggest. Several models have already depreciated up to 25% as manufacturers introduce substantial price reductions to boost sales volume, even if it compromises their profit margins. Financial expert Clark Howard asserts that the car sector has been experiencing a volatile roller coaster journey, beneficial for them, adverse for us. But he brings positive news. The roller coaster is currently veering downhill in our favor. Howard anticipates, for quite a while, dealers were setting prices significantly above the manufacturer's suggested retail price, and now the average vehicle is being sold at a discount. The most recent data from auto wholesaler Manheim shows that April was the second consecutive month where average new car transactions were below retail prices for the first time in almost 2 years. Additionally, manufacturer incentives have amplified. A crash in the car market is already underway. Prices are expected to continue to decrease every month for the rest of the year, Howard predicts. Manheim's graph displays prices steadily reducing from record highs, and given how overpriced they've become, the likelihood of a major double-digit price crash is increasingly probable. The latest Manheim index for used car value slid to 224.5 the previous month, which is a 2.7% decline from the April reading of 230.8 and 7.6% lower compared to the same period last year. In May, the trend of price deflation continued, pushing the index 0.3 points beneath our January outcome, noted Chris Frey, Senior Manager of Economic and Industry Insights at Cox Automotive, the company that owns Manheim. The report indicated that a consecutive year-on-year drop occurred in April as well, extending an 8-month trend of such reductions. This data revealed that we've seen 8 consecutive months of year-on-year reductions, averaging at 8.3%, and the end doesn't seem imminent, Frey further elaborated. During the financial turmoil, we encountered 16 months of annualized reductions with an average of 5.8%. In essence, the market is presently crashing at a more accelerated pace compared to 2008, when values plummeted by 37% within less than 18 months. The executive underscored the commencement of a secondary and swifter downturn from the pandemic's January 2022 apex, applicable to both pre-owned and brand-new car prices. The preceding month witnessed a drop in vehicle retail sales by 8%. Manheim's records show a decrease in sales volume on a monthly and annual basis. While some models experienced price reductions of up to $50,000 so far this year, these cuts were minor relative to the peak prices during the pandemic bubble. Yet the dip in vehicle prices, coupled with surging interest rates, is severely impacting dealers' profitability. It was pointed out that even before these developments, potential buyers were already reluctant to purchase new cars due to inflated prices and lack of budget-friendly options. The average monthly payment for new and used cars are $716 and $526, respectively, leading to Americans holding on to their vehicles for extended periods. The average age of U.S. cars on the road reached a record 12.5 years this year, as reported by S&P Global Mobility. As more motorists are deterred by the high costs of replacing their cars, a study by Payments in conjunction with Lending Club revealed a trend of Americans buying fewer cars as they reassess their purchasing approach amidst inflation. Nearly 55% of respondents reported not purchasing a car in 2022 and likely not planning to do so this year either. Consumer expenditure across all types of goods and services has leveled off. The Bureau of Economic Analysis, BEA, stated on April 28 that personal consumption expenses in March didn't differ from February, although consumers allocated more funds towards services like accommodation, utilities, and health care. This was somewhat balanced by reduced spending on motor vehicles and parts, gasoline, and other energy goods, as per the BEA report. The bubble for used cars has already burst, and new car prices are bracing for a more severe correction in the coming months. This downward trend may restore affordability for prospective buyers, but it's currently resulting in havoc for car dealers. In May, Howard revealed that the stock of new cars reached a 2-year peak, and a recent UBS report estimates that car production will surpass sales by 6% this year, resulting in over 5 million vehicles that will necessitate considerable price reductions to clear lots. Due to optimistic production plans, we anticipate a high risk of overproduction and increasing price pressure, UBS clarified in a client note. These price reductions are expected to escalate starting this month, with numerous car manufacturers preparing for a price battle and cutting prices to offload inventory. Cox Automotive has identified brands currently grappling with significant overstock issues. These include Buick, Jaguar, and Jeep, all of which have exceeded the ideal vehicle supply twofold. Chrysler, Ram, and Infiniti are nearly double the ideal supply too, whereas Lincoln, Dodge, and Ford are considerably overstocked by about 35%. Howard shared a dealer's quote saying he's been burdened with overpriced Jeeps that no buyers show interest in, and he'll take almost any offer. That's the predicament manufacturers have created. They've left dealers in a tight spot by forcing them to take on these unwanted, fully loaded vehicles while the market demands more affordable options. This situation fuels the ongoing reversal. As the inventory of new cars steadily increases, we anticipate a substantial downturn by December. Furthermore, buyers might have the chance to negotiate good deals as dealerships grow desperate and manufacturer incentives rise. UBS analysts observe a developing price conflict in the electric vehicle sector, anticipating its expansion into the internal combustion engine segment during the latter half of 2023. Leading the price reduction movement, Tesla, the electric vehicle colossus, reported an unsettling drop in first-quarter earnings due to shrinking profit margins. The profits registered at $2.5 billion, a near 25% drop from the same period last year. During a conference call with analysts, Elon Musk emphasized that the price reduction is connected to broader economic influences, suggesting the goal was to increase sales despite lower profit margins. Musk contended that the Federal Reserve's series of interest rate hikes were responsible for the surge in average car payments. The threat of recession and job loss means people generally delay substantial purchases, such as new cars. This pricing strategy led to Tesla's operating margin plummeting to 11.4% from 16% the previous quarter. Fabrice Cambolive, Renault's CEO, expressed his belief that car makers should perceive Tesla's price drops as a cautionary sign. The fact that Tesla is slashing prices is an issue that starts with cost. It's an alert that we're taking into consideration, he declared during an interview with Reuters. The company joined the ranks of car manufacturers discounting their models to boost sales before the economic downturn further suppresses demand. Kelley Blue Book's statistics show that the average transaction price for non-luxury new vehicles last month was $44,750, a $6,250 reduction from January. The average price for new electric vehicles witnessed an even more substantial decline. The average transaction price of new EVs sold in April was $55,089, a 7.5% decrease or $4,464 less than in March, and a significant $10,096 less than in April 2022. In 2023, new vehicle transaction prices are moving downward, providing a sense of relief for buyers after years of scant supply and escalating prices. Rebecca Radzetsky, Cox Automotive Research Manager of Economic and Industry Insights, commented, "When wholesale used car prices decline, retail prices usually follow suit." The firm suggests it might take between 6 to 8 weeks before we genuinely observe a decrease in retail car prices. For those requiring a new vehicle, this might be the chance they've been waiting for. However, it's wise to be patient as the downward trend has only just started, and the new vehicle bubble still has a significant distance to drop before market stability is achieved. For once, consumers could benefit from a car market crash. Conversely, manufacturers and dealerships will face serious financial hardships due to the oversupply issue, as we saw with retailers a few months ago. It won't be surprising to see a rise in dealership bankruptcies in the second half of 2023 as the recession takes hold. What ascends must eventually descend. It's currently challenging to predict the pace and depth of this crash, but it's certain to be profound enough to put major brands at risk during the imminent economic downturn. Thank you for tuning in.